Merry Christmas. It's December 26th. I've been spending a few days here around the Christmas holidays, kind of checking out different stats, watching YouTube videos of some real estate guys and kind of what they're projecting. A lot of information to take in. So I'm going to go through with what I've kind of picked up from all this and kind of where I think things are going. There's a lot of things moving in the world right now, so it's hard to predict, but we can kind of gauge some trends. So I'll share my screen here and kind of go through some quick information. Okay, so we're going to look at this is the M2 money supply. And as we came into the pandemic here back in February, March of 2020, the Fed shut everything down. And you know what happened? Everyone stayed home, no one worked, so they printed a ton of money. So M2 is the money supply that was thrown into the economy. And that money supply increased substantially. If you go back through history, all the way back, this one goes back to 1980. We've never increased that kind of money supply before. So this is kind of the wild card is, what kind of impact does this have? Obviously, it's triggered inflation. We've all heard about the inflation and it's transitory or not transitory. This is just a massive amount of money that's into the system. But when you look at the velocity of that M2, that money supply, the velocity has dropped. And this is third quarter of 2021. So it's not moving through the system very fast. So that means, it could mean a number of things, but basically people aren't spending it. The economy is not moving as fast as they would like it. So that's why they have to add more money supply. Then you kind of look at the employment. This one doesn't seem to make sense for the number of not layoffs, excuse me, but the mass exodus of working, so people are just quitting their jobs at record levels, right? But it's not really showing up in the employment to population ratio. Obviously, it dropped way down. To 51%, popped back up to 59%. So we seem to be coming back a little bit on that one. Housing all depends on income, right? And usually jobs reflect income. Maybe we're moving into different times where jobs aren't really the predominant money maker. If you're getting government checks, you really don't need employment. If you're getting stimulus, that is. So I think that's where we saw this massive run up on appreciation. So the real median household income and S&P Case-Shiller 20, those are the 20 markets. So this is the Case-Shiller index, and here we have the housing bubble. It shot way up, and look at how high that was compared to the median household income. And then it came back more in line. And then we slowly started the trajectory up. And then right at this pandemic, we shot way up. This would suggest we're in an affordability crunch. Household income is not kept up with home prices. Part of that is explained by the lower interest rates. So if interest rates come up, that'll force, more affordability issues, and that pricing is going to have to come down. And many people project that's what's going to happen in the housing market is interest rates are going to come up and the whole housing market's going to crash. I don't think that's the case, and I'll get into that later. I think we're going to have other factors that push that affordability issue, but this is the issue. Household income has to keep up with home prices for people to afford to buy. And then even if they go into rental properties, the investors still have to make that cash flow. So even if property values are this high, that rental income has to be high enough to support that. So it's a function of economics. Then we get into housing affordability index. This is in our market, Minneapolis. We've been tracking this for a long time. The Fred database hasn't tracked this very long, but basically, when we get into January 2021, it's 187.8. And what that number indicates is the median household has 187% of the income to afford the median home. So as this chart drops, when we drop into June of 2021, the median household income only has 146.5% of the income to qualify for the median house. So as that number gets lower, the affordability gets harder and harder for people to afford. And this is obviously just on the median level. Different markets throughout the United States are different. If we track the local market in the Minneapolis area, you can see we've tracked it way back to 2006, just before the crash. And when we crash, here's 2008, and we kind of go into, I should probably share it on this screen so you can see it. We go into, I got to look at it over here, about 260, 270% median household income to buy the median house. And then now we're way down to about 130. Yeah, it's 132 in November of 2021. So housing affordability has become an issue. So that is the lift in the market. When houses are cheap, lots of people can afford it. More people rush into the market, buy more properties. Speculation starts to incur, and we start getting bubbles. And I think we're kind of approaching that right now in different markets. If you look at the GDP, you can see in 2020 where this just plummeted. It just crashed. And then it shot back up, and this was all the stimulus, that M2 that we pumped into the system. So that artificially created this economy, which created this huge demand for housing. This is not sustainable. There's nothing behind it unless they keep printing money. So ultimately, people are going to have to go back to work. People are going to have to produce. So the GDP is kind of one way to track the productivity. So a couple things have happened. People have moved throughout the country. Part of that is from the SALT deduction, state and local taxes deducting. So that allowed people from California, New York, these high tax states to move into lower tax states like Texas, Florida. That's southern United States, where they have lower taxes, and they get a higher returning on their money. Pay less in taxes, basically. The other thing that happened is people were able to work remotely because of the pandemic, the shutdown. People jumped on Zoom, different virtual meetings where they can get online, conduct business, and things apparently go on as normal. I don't think that's going to last. I think productivity is going to drop. I don't think we've seen it yet. I go off the old kind of rule of thumb that business is face-to-face business. Belly to belly, you conduct business with people you know, like, and trust. And those relationships in the office place and with the consumer is what drives business. And those relationships can't sustain as well on video. So I think ultimately that productivity is going to drop. I think it worked well in the short term, but as people work from home, there requires more of a discipline. So I think companies are going to feel that productivity drop, even though they're saving money on leases and other expenses. I think they're going to feel it on the productivity, and we're going to see some of these companies start pulling employees back. Not all employees, but we're going to see a pullback to, come back to the office so we can kind of monitor the employees and get productivity back up and keep those relationships formed. I think we'll see that trend come back. So I think we're going to see some of these states call their employees back. In that big migration we saw, I don't know. We're going to still see that migration because of the SALT, but not because of the work from home. I think that's going to kind of go by the wayside. Obviously, I don't have a crystal ball. These are just kind of my guts on, you can't defy certain laws, laws of physics and stuff. And then one of them is, relationships. That has to happen for business to conduct. So then we kind of look at CPI, Consumer Price Index. That's inflation. So that's the blue line here. So we're going to track the blue line on inflation. And then the red line is going to be the Case-Shiller Index. So, it's tracking with inflation. But that spread is getting closer. That's just kind of a barometer. That none of these are going to tell the full picture. CPI is not that accurate. That's been manipulated on how they calculate it. So if we go to Shadow Stats calculates it in the way that they did prior to 1990. And so Shadow Stats is showing that we're closer to that 25%. No, that's unemployment. Consumer inflation. Here we go. So 1990 based, we're at a little over 10% versus the CPI showing it at about 7%, 6.5%, somewhere in there. So inflation is hotter than the CPI is showing. And then the medium sales prices of homes in the U.S. So just right before the pandemic, we're sitting at about 329,000 first quarter of 2020. Everybody was locked in, worked from home, and then we pumped a ton of money into the economy, and then all of a sudden house prices shoot up to 404.7. Okay, part of that's low interest rates, right? The government printed a ton of money and then created low interest rates, and a lot of that got dumped into asset prices in the housing. So 404.7. So if we look at, now I got to share a different screen with you here. So let me stop sharing, share a different screen. Window. All right. So this is just an image of Kentucky windage, right? We're trying to guess where the market's going to go so we know where to be. So property taxes. So what I noticed back in the 2006, 2007, 2008 run up on house prices and subsequent crash is the first thing that went. It was not the mortgage rates, the locked rates or the adjustable rates adjusting. That happened later. So the first thing that happened was there was a run up in prices, and then the cities started adjusting the mill rates. And the mill rates did go up, but that wasn't the real issue. The real issue was the value of the property shot up, and then it took about 2 years, a year and a half, 2 years, and then the cities started to adjust and the counties, I should say, adjust their taxes based on the new value. Okay, so we go back to first quarter 2020. Right now, all homes are taxed at basically this value of 330, the median home price. This is nationwide stat. It's different in every market. There's a different mill rate in every market, and some cities are greedier than others. Some counties are greedier than others. So, depending on where you're at, I'm using 1.5% of value for the mill rate. That's a little strong in some areas. It's about right for other areas. So it's just relative to where you live. So third quarter, we shot up to 404,700. That's a 75,000 increase in value. So if we estimate the tax difference, that's about $100 a month increase in taxes. Okay, it doesn't sound like a lot, but you're going to go from $411 a month to $506 a month in taxes. Okay, so now you've qualified for your mortgage. You bought in, let's just say at 404. Your taxes are based on the 329. You qualify right at that level. And a year later, all of a sudden you're shot up another $100 a month in property taxes. Okay, you're going to feel that pinch. It's not going to make or break you at that point. But now we have other inflation. Okay, so now you have property taxes, just say going up by $100 a month. You have gas and electric. Okay, fuel costs are going up sky high. We don't know what the natural gas, if you're in the northern part of the country, you're going to spend a lot in heating your home like I do. So $100 a month increase in gas price for here is not unreasonable. And then that'll be reflected in the electricity, right? Because a lot of the electricity is generated from natural gas. So that's going to go up as well. Okay, so you're going to have utility costs go up. I'm not even going to calculate in the repairs and maintenance on the house, but everything's going up in price. This is that 10, 11, 12% inflation that we talked about on shadow stats. Now, outside of your housing, you have gas for your car. We've seen that double, right? The food prices, if you buy groceries, that's going up. And we talked about that inflation. So, just take that property tax at $100 a month, 3.5% at 30 years is approximately $22,000 in purchasing power. And so if you did 200, just the gas and electric and the property taxes, that's 44,000 in purchasing power. If you subtract that off of 404.7, you're down around 360. And that's not to say that's scientific. That's not, that's where the house prices should be. That's just try to represent the the impact of this inflation, and then what these property taxes are going to do is they readjust the values on their mill rates. This is going to really bite into the consumer, and inflation will ultimately bring up that wage and that income, but there's going to be a rough time to get there, and we don't have anything to really go back on printing that much money to inject that much money into the system, and how we're going to adjust to that. That's what I'm struggling to get my head around. There's a lot of lift if you want to compare. Jason Hartman does a great index where he compares the house price to, say, coffee or gold or whatever commodity you want to compare it to versus just dollars, right? Just to kind of break it apart from the inflation so you understand the real value of the house. The problem with his calculation is it doesn't reflect the income. And we don't have a great chart to really show that. The Housing Affordability Index is probably the closest one that we have, and it's not perfect by any means. But again, we're playing Kentucky windage, right? It's not going to be scientific. We're just trying to gauge where that market's going to go and how do you position to get, how not to make a poor investment if you can. So basically with that said, if we're kind of seeing where this market's going to go, you're going to lead in here. The market has some lift left in it, especially if you're in the southern country, right? You're going to have that New York, the East Coast, the super high expensive housing. They're in a very different kind of market, and they're moving into more of a free market. And I don't think those buyers quite understand what they're getting into. Not to say that they're overbuying, but Florida, you can build houses cost effectively. You can develop land. There's a lot of freedom in Florida and Texas and those southern states. Where New York, you're very confined. You can't add housing stock. So that housing stock is artificially high there. So people are cashing out on these overvalued houses in those states, and they're going in and everything looks cheap in those markets, and they're going in and they're driving up the pricing down there. And I think we're going to be surprised that Florida and Texas are going to allow people to build more houses and the house prices will kind of balance out. So I think there's a micro bubble forming there. And I'm not an expert in those markets. I'm way up in the North Country. So just, consult with the local agent down there on what you're getting into. Right now, things are red hot down there. I do own some property there. I'm selling it now. And it's not that I don't think it's going to go up in value more. I don't want a capital gains. I want cash flow. So I want to redeploy those assets into something that's going to deliver cash flow versus speculating on continued growth. I'm a little nervous on getting into capital gains right now. I see there's going to be a lot of resistance on that price growth. And that price growth is it's just the inflation is going to hold it down. The interest rates are going to hold it down. I wanted to touch on the interest rates. I really didn't do that. A lot of people were speculating that, once interest rates tick up, this whole housing market's going to crash. I don't see it that way. There's two things going on. The government printed a ton of money. The government has to pay that money back in what the interest rate is. So they're going to kind of manipulate the markets to keep that interest rate low. And we're going into an election year. So there's not a lot of political appetite. If you raise the interest rates, you're going to slow that market down. They tried this back in 2019. They started raising about a quarter percent. I think it almost went up a half a point, through the year. And then the market really started to slow down. Not the housing market, the stock market, the economy. So then they eased back off on it. And then we went into the pandemic and then they just flooded it. So I think the Fed is kind of boxed in where they can't raise that rate too fast. I do think we'll see some movement up on rates, but I don't think we're going to jump from like 3.5 to 5.5. But, if we go 3.5 to 5%, that's only $87 a month. That's about $16,000 in purchasing power, roughly. So just that the taxes alone, the property taxes, once they adjust the mill rate or the assessed value to reflect the sales price, that's going to, I think, be what holds that market back from going much higher versus, say, an interest rate adjustment. I think that's going to be a stronger stronger thing that slows the market down. I noticed that back in 2007. All of a sudden, all the properties, the mill rate or the assessed values went up to reflect the sales price, and then that market just seemed to stall out. There was just no more lift but below the wings. People were maxed out on their monthly payments. And then we started seeing the interest rates go up a little bit. And then once the adjustable rate mortgages reset, then the whole thing imploded. And then the rest of the story. So I think that's where we're headed. So if you're kind of positioning to buy into investments, look for cash flow. Make sure that underlying asset, that there's cash flow supporting that asset. If you're looking at capital gains, be very careful, understand the market you're going into. There's a lot of shaky stuff going on in the economy worldwide. That pandemic isn't over yet. Whatever you believe that pandemic is, there's a lot of stuff happening out there. China's got issues. There's that whole supply chain issue. And then more importantly, which we don't hear much about, is China's got this huge energy problem. I've been lately reading that there's kind of a trade war with Australia getting the coal into China, and that's really put a crush on their energy supply, which shuts down their manufacturing. They have demographic issues, not to mention the whole housing market is smoke and mirrors over there. You have Evergrande, which is basically in default. You have the whole, I think it's like 25% of their whole economy is based on that. Not just Evergrande, but all the investments into real estate. They don't really have a stock market per se. They've been investing into housing. So they got a huge oversupply of housing. The exact problem we have in the U.S. That's going to impact its way through the global economy. There's a lot of headwinds. I'm going to be a little cautious going into 2022. Anything I do is going to be it's going to be supported by rents. There is a shortage of housing that's going to persist. We can't correct that anytime soon, but make sure that you can carry that with rental income and buy in the right areas, buy the right product. And it's not a speculation business. If you want to get into speculation, excuse me, maybe go into look at some of these NFTs like Sandbox. Get into that virtual real estate if you want to play speculation and capital gains. That's kind of an intriguing market too. And that's something to look into. But I'd be very cautious going into the housing market into 2022. We're going to see some dynamics start to unfold. I think National Association of Realtors is predicting about a 5% increase in property values. And that's lower inflation, right? If inflation's running at closer to 9-10%, 5% is barely pacing it. So, is that crashing up is kind of the term. It's not keeping up with inflation. Now, nominally, it feels like you're making money, but you're barely pacing inflation. So the thing to watch for is the wages, the income to support the housing. Housing ultimately follows the people and what they can afford. And you got to buy real estate. It's a service business. You're providing housing for people. So you can buy houses cheap in a lot of areas, but there's no people to live in them. So with that, that's kind of my thoughts. I've been kind of eyeing this, trying to predict where things are going. I know there's no exact science to this. Like I said, we're playing Kentucky windage. We're trying to guess where this thing's going. There's a lot of factors going into it. And you just got to go with your best gut and your best guess. So that feel free to comment, like this. And if there's any questions you have, post it in the comments. I'll be glad to answer the best I can. Thank you.